Good afternoon, and welcome to the Wealth Factor webinar. The topic today is the importance of having an investment plan. And from a wealth factor perspective, when we talk about planning, it's purely from an investment perspective. It doesn't mean that there aren't individual financial considerations that go into the foundation of that plan, but we're not talking about the what the mass advisor looks at as a financial plan, something that's really more holistic. I believe that the value that can be added uh, is much higher on the investment side versus the overall financial picture side. And that, I believe, magnifies as the size of an investor goes up. As an investor, uh, if you think about it from a classification perspective, high net worth or ultra high net worth investor, it starts to make far more sense for those investors to have a team of experts, tax, estate, etc. And absolutely, does that team, including an investment expert, need to have coordinate and perhaps to some degree have a quarterback, but I don't think any one individual, especially whether somebody coming from the investment industry, is the right person to be driving that process, perhaps organizing it, perhaps quarterbacking it, but beyond that, I don't think it makes sense. And so, my focus from an investment perspective is plan based and investment advice centric. So, before I get too far in, I'm going to say a few words for my compliance friends and for compliance purposes, and I'll read these so I get it right. This call is for informational purposes only and may be recorded. Statements made during this call are subject to risk and uncertainties, some of which are significant in scope and by their very nature beyond the control of Wealth Factor. There can be no assurance that such statements will prove to be accurate, and actual results in future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. So I'll start out with, for those of you who don't know me, a bit of background. I started my investment experience in the building up of the tech bubble, and so my perspective from an investment standpoint is very much filled with cycles of boom and bust and environments where we see prices declining materially. The first thing, the tech bubble, the financial crisis, and now what we've seen so far this year. I started my career out doing trading work for a alternative asset manager in the Portland area. I had the opportunity to start my own business, which was called my first business called Bandon Capital Management. I launched that business in 2007. Within that, made the decision to launch a mutual fund. I did that in 2011 and managed that for a number of years. That mutual fund happened to be in an area of the industry that was fast growing, and that attracted the attention of a public company who ended up acquiring that mutual fund business line from me, and I joined them, acting as a managing director. I launched Wealth Factor at the beginning of 2017. The goal for Wealth Factor from a business perspective is to take what was uh, a more national focus to my investment business activities, and bring them more local. There were some personal motivations of not needing to travel as a part of that, as my family is become a significant priority. So launched that in 2017. So Wealth Factor is a Lake Oswego based and focused investment advisor. What we do is provide customized plan-oriented investment advice. We deliver that through managed portfolios that are, again, customized. We build those portfolios almost exclusively based on indexes, and they're largely comprised of stocks and or bonds. Our client accounts are held in their individual names and held at third-party independent custodians. And we generally act as fiduciaries on behalf of our clients. We charge a 0.35% fee based on the assets that we manage for clients up to the first 10 million in assets, and then 0.1% on assets over 10 million. So a couple quick slides to share both our philosophy and then kind of I think it's always helpful to spend a little time on the longer term context before we get into details. And so the core driver for Wealth Factor is rooted in the idea that investors should focus on efficiency. And so our philosophy we call risk smart, and there are three different component parts to that. The first is what we call portfolio smart, which is really a reference to the structural efficiency in which the investment advice or the portfolio is being delivered. And so there are two key components here. The first is based on the idea that picking and timing investments are both unlikely to be successful and then an inefficient activity. So to the extent that you're dependent on picking a stock or picking a sector or timing any of those, any types of investment decisions, those take lots of energy and effort, which would drive fees or costs up. And then they also increase complexity too, which again, probably also drives fees up. The second component of being portfolio smart is the avoidance of layers as well as complexity. So I believe layers of management, layers of different component parts, increase complexity and reduce efficiency. And so number one, being portfolio smart. Number two, being fee smart. And the 0.35% fee at Wealth Factor is certainly unique relative to industry norms. And then in addition to our fee structure, when we're basing our investment portfolio deliverable for clients on indices, it allows us to maintain simplicity and then cost efficiency. The last component is tax smart. And this is an area that is often an afterthought for both individual investors as well as the advisory community. But it's my belief this is one element through an attention to these details where significant value can be added. So this page here is, I'm going to start with this before I go into my comments about the importance of having an investment plan to share some longer term perspective. So the start of this year has been filled with uncertainty and lots of scary media headlines. And so what this illustrates that there are constantly things in the economy, in the news, in the geopolitical environments that give us reasons to be concerned and ultimately reasons not to invest. And so, we see here that in the 70s there were a variety of uncertainties all the way each decade, all the way to 2020 in our current environment where we have both the coronavirus pandemic, the concerns of businesses shutting down and becoming inactive. While these are unique to today, the idea or the occurrence of unique things isn't unique. It's been persistent and consistent. And so I believe that in order to be successful, investors need to focus on something that's not the scary element of the day or the week, quarter, whatever it is in the short term, and have a plan in place so that an investor can stay consistent with their underlying exposures. If we just look back over the last handful of weeks, the most scary time was to be invested was likely the very best time to buy. or not sell. But if you're allowing yourself to make decisions without a plan and driven by emotion and an attempt to follow daily information, I believe that's setting yourself up for a suboptimal outcome. So now it's kind of transitioning over towards this concept of what should we consider as we build an investment plan, and what might that plan look like. And so starting out here, how should we think about these sorts of periods, or periods like this, because these types of environments that we're in right now are going to be the ones that have the greatest impact to our success. And so let's start out with one element that I think is really good to just clear out of the way right away is there's going to be bottoms in markets, and the probability that we time those is really, really low. So if not perhaps completely impossible. And so any endeavor that we exercise to try to do that, I think it would be a suboptimal, that energy would be poorly spent. Secondly, and as we've largely seen, is once markets start going up, it likely will happen very quickly. So once we feel comfortable with the idea of being invested, the biggest opportunities that we might see from a financial market perspective have largely already passed. So a little bit more about these sorts of environments. So should we be nervous in environments where we've seen significant declines? I don't know the answer. There's no concrete answer to that. I mean, naturally, yes, we will feel nervous. We're humans. But again, kind of reinforcing the need or the benefits associated with having a plan is, let's go and do an exercise where we look at some data. And so what I did with this exercise is I took the daily returns for the S&P 500 going back all the way to 1927. And then I looked at the rolling 12-month results. So lots of little 12-month periods, because I was using the daily data, and identified and then isolated which periods were down at least 25% over 12 months and down 35% over 12 months. And then I looked at the following 5-year periods and 10-year periods to see what the performance was after periods where we had significant declines. And then I broke that into 2 other segments, 1960 to 1979 and 1980 to current. In my original analysis, I broke it into lots of 20-year periods, but there ended up being overlap, and so there wasn't much benefit in doing that. So I consolidated the 1980 to current period. But what we see here is, in all periods from 1960 on, is that there were no occurrences where in the following 5 years the stock prices weren't or stock gains. There weren't gains in stocks, or at least the S&P 500. And so I don't use this to suggest that that's always going to be the case, but really to push back on this idea that we should be thinking about selling, or we should be concerned or nervous after prices go down. And so there's a couple of cliches I have in here. One's a quote from Warren Buffett: "Be greedy when others are fearful." The second, "Buy low and sell high." When you say these in isolation, they feel very obvious, but I can tell you that of the conversations I was having with both clients as well as prospective investors in the middle of March, these were the last sorts of things on the average investor's mind. And again, if you have a plan in place, there's a framework so that you can ignore, again, the scary elements of each specific day, week, month, and take advantage of opportunities in the market as they arise. So as we then shift the attention towards what you might consider when building an investment plan, I always like to start with the long term in mind. So investors, if you define, or if I were to define the idea of being an investor, it's somebody with a longer term orientation to what they're doing, at least 10 years. And so there's a natural challenge in publicly traded financial markets where you can sell all day long every day, or buy all day long every day. So I think it's key to, you absolutely want to have that ability to do that. But if you're truly an investor, the transacting regularly is probably counter to that orientation. And so start with a long-term framework. So what might you, as you build that out, what are some key considerations? First, what percentage of an individual's overall wealth is needed for the near-term obligations? That part really shouldn't be thought of from an investment perspective and should be excluded. The second is, does it make sense to own illiquid assets, whether that's investments in private equity or private companies or real estate? And the answer to that varies based on each individual, but that should be earmarked, and then probably some sort of liquid assets to support those assets during periods of financial strain. And then, so from there, the remaining buckets might be, what allocation should go to riskier assets versus less risky assets. And there are two elements here, at least from a historical investment advisor, financial planning oriented construct and looking at this. And one is, what is the time horizon? How long until these assets or investments need to be utilized? That's number one. And number two is be the risk tolerance for each individual investor. And I largely, when I create plans, ignore that risk element for each individual investor, because the average person wants to be is comfortable taking risk at times when prices are high, and they're uncomfortable taking risk when prices are low. And so, we're all aggressive when we have this tendency, if we allow our human decision making to influence what we would do. We're all comfortable taking risk when it feels good, and then not comfortable taking risk when it doesn't feel good. So I think that element should be not necessarily completely ignored, but minimized in its effort or its focus, in lieu of a focus on what's the time horizon for the assets. So if you're 5 years from retirement, the composition of risky assets versus not risky assets should be driven largely by that. Or if it's 15 years from retirement, or whatever the purpose for the invested assets are, that should drive a much higher target exposure to riskier assets than somebody with a much shorter time horizon. And then lastly, identifying prioritizations and acknowledging that prioritizations change over time. And so the two key ones here are income generation versus tax efficiency. And while those two things are not perfectly mutually exclusive, generally income-oriented portfolios are less tax efficient in that they have tax liability each and every year. So then, I think going down a level of detail is develop a structure for targets from a stock market perspective. Things like how much geographic diversity do we want? What's the composition from a size of company perspective? And then what sort of factors drive how the portfolio is constructed? And so it's common to see investment advice stop there and say, okay, we created an asset allocation. We're just going to blindly follow that and ignore everything else. I think that this approach, first of all, I think that that approach will work. I think that there's opportunities to create a short-term plan around that. And I think these short-term plans are specifically useful during periods where there is a heightened amount of price volatility. And as we're seeing so far this year, price volatility doesn't just mean downside volatility, it can mean upside as well. And so while markets are moving very fast, I think there's opportunities to put a plan in place to try to effectively increase the chance that you're buying low and not selling low. And so what might a plan like that look like? And so, this is an example, and the example could be implemented in multiple ways, not just this very simple way. And so, what this example does is takes and compares a buy and hold portfolio of $3 million to somebody who, and this is very much apples to oranges, right? To a somebody who's uninvested and what they might do versus just putting all of that in. Another application for a plan might be somebody whose general target exposure is 50% stocks and 50% bonds. A plan could be put into place to increase their equity exposure after declines from 50 to 60, or potentially even 60 to 70, et cetera. So this is just an example that illustrates a methodology to potentially increase risk at points where prices are lower. And so what we have here is, so on the left, it's just to kind of share what this is that $3 million portfolio down 30% is kind of the starting point for this analysis, which we did see that at some point during March, but we're well off of that today. And then the buying program on the right suggests that, we're going to put in 3 different 1/3 increments, starting at that point where we're down 30%, and then as markets fall from there, increasing the exposure. So I'll pause here and highlight the elements here that are practical. This program, just like anything that you might do from an investment perspective, is there are pros and cons. And so the biggest disadvantage to this is that there's a high probability, I think, that this exposure will never happen. We'll never see those price declines that drive this. And so the benefits are a reduced risk and a potential opportunity to participate in as prices revert, but there's a high probability of not getting invested at all. And so I look at this as a strategy that might reduce downside. And so there's a couple of mathematical elements here that can be highlighted. So first, as you look at the decline and so that third column, percent from the top, as you go from down 30% from the top to down 37.5% from the top, the percent change of your dollars are actually down 11% during that period. So the math changes as the total size or basis changes, and then that same phenomena occurs. And so as you keep going down, so it's down 30% from the top, all the way down to down 50% from the top, and then as we continue to go down, now we see prices recovering. And so from going from down 50% from the top back up to only down 30% from the top, that's a 40% move in those prices. And so you can see that benefit on the right side of a investor who is putting new dollars to work at these lower prices, in that they're very quickly back to even or profitable, and then up significantly at the point where markets get all the way back to where they were at former tops. So again, this isn't intended to be a wholesale investment plan or short-term plan solution that applies to everybody, but an example of something that can be put in place to minimize the challenges associated with dealing with the emotions that are natural during the periods where we see the highest amounts of downside volatility and lower prices.